get ready for a wild week. Not only do we have the normal economic data, earnings reports, but we got a lot of Fed speak. And of course, we'd be remiss if we didn't talk about the stupid debt ceiling drama. All of that ahead. We will talk about the top 3 cities for new college grads, and we will have a conversation about interest rates. So let's get into the news. This is your Sunday, May 21st daily financial news. First, let's just tell you that we are about to have a full onslaught of Fed speak. By my count, we have 6 or 7 Fed speaking engagements starting on Monday, going throughout the full week. Again, if last week was any indication, most of the Fed speakers will be saying something like data dependent, higher for longer, not seeing, they basically want to take a cut off the table. The market, I think the S&P, NASDAQ, and Dow, certainly the NASDAQ and S&P hit 52-week highs last week. I do think they were down Friday. Let me just tell you that I do not think Jerome Powell or any of the Fed presidents had stock market at 52-week highs on their bingo card. So that is not something that they are necessarily excited about. So I expect the Fed to be aggressive all week and all of their talk tracks. They will certainly lean hawkish, not dovish. I haven't changed my mind. I still think the data coming up, including the next CPI reading, will be weak or below expectations, and we will get a pause. But again, the Fed's job is, in my opinion, to talk tough. They don't want the market pricing anything in ahead. You have seen the odds of a pause drop dramatically post Jerome Powell. It went from 98% pause, 2% cut, to now I believe 63% pause, 37% raise. So a dramatic change, and that is exactly what I think the Fed wants, is they want to go higher for longer. And this will have an impact on rates. You have seen the 10-year note rise quite significantly last week, which has taken the mortgage rate significantly higher. We will talk about that more in a minute. I think the thing that will probably come to a boiling point sometime around Wednesday or Thursday of next week is the debt ceiling. Again, I haven't changed my opinion. A lot of this is theater, just politicians trying to get, their stuff, their talking points, all this noise. I can't imagine the catastrophe that would occur should a debt ceiling violation happen. So again, I will hold out hope that a deal is struck, even if it's a short-term one, and we just keep the drama going. But again, I think the debt ceiling drama is already impacting the bond market, right? I think the bond market is really raising rates just out of anticipation. The risk of a default is not zero. So of course, the bond market is reacting. You have that plus a bunch of tough talk from the Fed. You see a lot of rise in interest rates. Again, we will talk about mortgages in a minute. So buckle up. Next week is going to be full of theater. It is going to be full of just hawkish and nonsense with the debt ceiling. So just buckle up, be ready for it. Don't overreact, just understand and watch what occurs. Let's talk about some economic data next week. We do get a bunch of it. Starting on Tuesday, we get new home sales. I expect new home sales to be a bright spot for the economy. I expect home builders, frankly, to do really, really well in the environment we are in. How can that be? Well, as we have shared repeatedly on this channel, as interest rates go higher, and they did last week, existing home sales will slow down. People will transition from existing home sales to new home sales for one simple reason. If you want a 4.99% mortgage today, you can get them. Yes, you can. But you need to go to a home builder who will buy down the rate instead of lowering the price of the house. So we are going to see builders continually offer rate buy downs and get people into homes with a 4.99% mortgage. So that's why I expect new home sales to do quite well for the next several months. So we will see that on Tuesday. On Wednesday, we will get the FOMC meeting minutes. What is that? Basically, that is a rundown of the talk track at the last Fed meeting. This generally comes out about 6 weeks or so after the last one, or 3 weeks, 3 weeks after the last one, and we get to see really what they talked about, right? I'm going to be looking for anybody talk about a pause, anybody talk about unemployment rate, any expectations of negative GDP, recession, all of these things. Remember, one of the big takeaways from the last meeting was Jerome Powell said, my team sees a recession and I don't. He didn't say it that succinctly, but that is what he said. So I'll be looking forward to that. Then Thursday, we get pending home sales. Pending home sales will be interesting, right? What happened last month? Are they up, down? What are we seeing for inventory? I expect pending home sales to be a little weaker than expected just because there's no inventory. We are seeing bidding wars, offer review dates, over asking. But at some point, if there's no inventory, there's no pending home sales. So again, going to be very, very interesting. On Thursday, we will also get initial employment claims. This is something you and I look out for every week. It's the most consistent and likely early indicator that the job market is turning. So Thursday is an important day. And then Friday, we get PCE, personal consumption expenditures, both headline and core. That is important because, again, the Fed has told us PCE core is the number that they watch most frequently. Of all the inflation metrics, and there are lots of them, PCE core is the one that they look at. So very, very interesting. So lots of economic data, Fed speak, debt ceiling. Not to be outdone, we do have some key earnings next week. We do have some key earnings. Starting hot and heavy on Monday with Zoom. Zoom video, right? What is going on? Return to office. Is it a pandemic darling? What do we see? What is Zoom doing? What are they looking to add to their portfolio to have cross-sell, upsell, things of that nature? Tuesday is going to be a really important day. We get Lowe's. Remember what Home Depot did last week? Ugly. Ugly. Will Lowe's do better? We shall see. We will get AutoZone. AutoZone, right? What is going on with the car market, used car market? Are people keeping cars longer? What's going on? Palo Alto Networks. Again, one of the things in technology that I look for is security. It's that one investment that I have found in software people still spend on. Is Palo Alto Networks still crushing it? Or will they come out and say, hey, our sales cycles are elongated. We are seeing people make trade-offs. I think some security player will tell us what is really going on in software, and it might be Palo Alto Networks. And not to be outdone, on Tuesday, we will need to talk about Toll Brothers. Toll Brothers, luxury home builder. Clearly above the median in most markets that they serve. This is a market that I think is tough. But because they can buy rates down, it will be very interesting to see what is going on at Toll Brothers. Wednesday, NVIDIA. Wow, talk about a crowded trade, talk about AI. We should have a drinking game. Every time somebody says AI on the NVIDIA conference call, you have to take a shot. I imagine most of us would pass out. I'm going to guess that AI is said 30 times, 40 times. It's going to be said everywhere because, again, you've gone from being the chip maker for crypto to now the chip maker for artificial intelligence. We will get Kohl's, another retailer, what is going on there, and then Snowflake, one of those SaaS providers. Again, we're not necessarily, at least I'm not necessarily interested in Snowflake per se. I'm interested in what they say about sales, longer sales cycle, user counts, renewals, things of that nature. Then Thursday will be an important day. We get Best Buy. Is Best Buy like Foot Locker? Foot Locker, again, had an atrocious earnings announcement for Friday. I just recorded the daily financial news for Friday. It will post at 8:15 this morning. 8:15 it is scheduled. If you want to see my discussion on Foot Locker, it will be there. So again, is Best Buy like Foot Locker, where people bought ahead, they're pulling back? Very interesting. Gap. talk about somebody who has had a rough year or so, what is going on there. RH, Restoration Hardware. Remember, RH had an atrocious earnings call last quarter, but at the time, Warren Buffett or Berkshire Hathaway was kind of the floor because they would keep buying. Again, remember last week in a filing, Berkshire Hathaway sold their RH holdings. So another bad quarter, we could see some pain. And then finally, VMware report as well. And then finally, the week will close out with Big Lots. What is going on in kind of discount retailing, we shall see. So again, lots of stuff coming next week. Now let's talk about interest rates. I believe we are going through that last hurrah in interest rates as they explode higher solely because the Fed is talking tough and we have this debt ceiling drama, which is ridiculous, but still we have to get through it. So likely what we will see over the course of the next 2 or 3 weeks is interest rates head higher. We likely will see a 7 handle on mortgages sometime in the next 10 days. And then as inflation becomes clear, as the debt ceiling is resolved, as economic data gets weak, rates will start their slowly fall down, ultimately ending below 6% sometime late summer or September. But again, having rates that high means something. So I had some thoughts on that. So again, what does it mean? I think active inventory listings go up 8%. Why? Because existing homes will sit longer. Active inventory up. New listings continue to be down 20%. Why? You and I have talked about interest rate lock-in. We nailed that one a long time ago. It's still, the higher rates go, the more move-up buyers stay put. Days on market. Days on market will go up at least 7 days, which is quite a move. It's like 20%. So again, active inventory up, new listings down, days on market up, prices flat, stubbornly flat. Transactions are going to be down, right? We're going to do like 4 million, 4.1. But again, prices, no crash here, folks. I am sorry. And then finally, lastly, new home sales will surprise higher. Again, the answer is very simple. New home builders can buy rates down. When you buy a new home, you get a rate sub 5%. You buy an existing home, you're going to get something with a 7 on it. So why do that, silly? Spend the extra $30K for new home and actually get a lower payment. That is exactly what new home builders will be doing. So again, that's what's coming. I read a very interesting article about the top 3 cities for new college grads. Again, this can be found on CNBC Make It if you want to go check out the article. Number 1, Lubbock, Texas. I don't actually think I've ever been to Lubbock, Texas. The starting or median salary in Lubbock, Texas is $57,000. Annual living cost in Lubbock, Texas is estimated to be $32,000. And the unemployment rate, yes, folks, the unemployment rate in Lubbock, Texas, 1.7%. Shout out Lubbock, Texas. Nice work. Next up, Bloomington, Illinois. Bloomington, Illinois has a median salary of $72,000. Yes, $72,000. Has a living cost of $33,000 and an unemployment rate today of 2.4%. And the final city highlighted in this article, again, top 3 cities for new college grads, is Kalamazoo. That's a fun word to say, Kalamazoo. Kalamazoo, Michigan, with a median salary of $60,000, annual living expense of $32,000, and an unemployment rate of 2%. So again, folks, really, really cool stuff. Before we get into the 3 steps to get wealthy, I want to congratulate Aaron and Michelle. Aaron and Michelle, congratulations for getting your next deal. Your card will go out in the mail today. It's already stamped and ready to go. Lastly, folks, I want to talk about the 3 steps to get wealthy. 3 steps to get wealthy. Remember, stack cash, discretionary income, live below your means, increase your income, whatever it happens to be for you, or both. 2, Get elite at something. Find your thing. It doesn't have to be housing. It can be stocks. It can be sports cards, wine, classic cars, whatever it is. Go focus. Become unbalanced. Become elite. And then number 3, folks, of course, it takes time. I think you can get wealthy in 10 years or so. It is all about consistency and all of that. If your thing happens to be rental properties, I strongly suggest you look at my program, How to Get Started One Rental at a Time. If you want to kind of try and buy, I do have a 2-hour session on your buy box, which is step number 1 of the program, 2 hours, where we go through a buy box in detail, pull up realtor.com, look at students' examples. You can get that for $47. So again, folks, go ahead and take a look at that stuff. If you want to get wealthy in real estate, I can help. If you want to do that in stocks or crypto or wine or classic cars, I'm sure there are amazing resources to follow. You can do it. I believe in you. But remember, the 3 steps all work together, right? Don't get 3 or 4 years into this and then change your mind. It does take compounding, stacking dollars and all of that. Folks, have an amazing day. I am so excited because I get to talk to 3 of my best friends, Mike, Dion, and Matt. We're going to do a 3-hour session for about 80 people to talk about their portfolios. We're going to do that for 3 hours. It starts in a few short minutes. I'm going to go get ready, folks. Take care of yourself. Have a wonderful day. And again, Aaron and Michelle, congratulations. Bye-bye.